start today with part of the contents, and then we will continue tomorrow. And also, the tutorial for tomorrow afternoon will cover the cash flow statement. Yesterday I uploaded on Moodle the tutorial exercises for tomorrow. Every time you check the Moodle under the category exercises and questions, you will find the tutorial questions in advance. So beforehand, before you come here, you can have a look to the exercises that we are trying to solve together. Whereas the Excel spreadsheet that we generate during the lectures, well, normally they will be uploaded on Moodle after the class, okay? So maybe if you don't have anything for us to discuss or something, we can start. Good morning to everybody that is following us from their homes or offices or remotely. Can you hear me okay? Is everything okay with the audio? I can see that the video is not working today. I hope the audio is okay through WebEx, and I also hope we will not have problems with WebEx this morning. Can you hear me all right? Okay. Thank you for the feedback. So we can start maybe, and then, as I said, we are going to really take this really slowly and grasp everything step by step, let's say. Whenever you feel it is too much to process, just ask me to repeat things over, and we will do that. Again, theoretically, it may seem easy, but when we go into exercises and really detailed knowledge, it may seem like how each piece connects together. It is a little bit difficult. But still, we are going to see simple cases and also more difficult problems. So what is the statement of cash flows? As you can see, it's not in vain that we are stressing and emphasizing this statement. You know that there are four important financial statements, right? There is the balance sheet or the financial position statement. There is the profit and loss account or financial performance statement. And also there is the statement in changes in equity and retained earnings. About these three first statements you have already discussed, but you have not discussed in details about the statement of cash flows, the representation, the format, the layout, and what is more complicated, the way that we prepare this statement. How we prepare statement of cash flows. Now, if I am well informed, in the first part of the course, you tried some simple exercise how to prepare a simple balance sheet, taking the account balances and putting in its right places in the balance sheet. Is that correct? Okay, so you know how to prepare a balance sheet, a financial position statement. And you know how to prepare a simple profit and loss statement, right? In this part of the course, we will learn how to prepare a simple statement of cash flows, but not only simple, but also some complicated statement of cash flows. When you look at this statement in the annual reports, maybe it will look like it has many items that are not really similar from one company to the other, and that may be okay because this statement focuses on cash flows, that is, on money that is going in and out of the company. And therefore, it may be very different between companies. How do they generate the money or the cash flows, and how they spend their money? Where do their money go, mainly? So this is why there are a lot of differences between companies. And when you look at their statement of cash flows, maybe you will find that there are not the same lines over there. Again, this is based on the fact that different companies generate and use their cash flows for different purposes, or generate their cash flows from different sources. And therefore, we expect to have a lot of variety and diversity between companies. Okay, so maybe we can start emphasizing the importance of the chapter. It is one of the four main mandatory financial statements. Without knowing how to prepare and understand the statement of cash flow, we cannot go further in our course. So being it that important, we can start and discuss about what our learning objectives for this part. First of all, we will discuss about the need for a statement of cash flows. Somebody may have already thought that, okay, we already have 3 other financial statements, right? We have the balance sheet, we have the profit and loss statement, and we have the statement of changes in equity. And you can take 1 copy from each file. 1 copy from each file, it's okay. So why is a 4th statement even needed? Is that meant to add to the complexity of financial information? Or is this statement really special and it provides some specific information that it is not already provided from the other 3 financial statements? So why is it needed in the first place? Then we will describe the requirements of IAS 7 and International Accounting Standard number 7. It is the one that really covers in details the preparation, disclosure, things and paragraphs about the statement of cash flows. Then we will learn how to prepare a statement of cash flows through 2 different methods. There is the direct method and the indirect method. And as there are 2 different methods to prepare the cash flow statement, this adds to the complexity of this issue. So the statement is complex, but it also has 2 different methods how to come up with this statement. So this is where it becomes even more difficult. Then we will try to identify any problems that are related to the statement of cash flow. Now this is a very important statement and it's a very good one, but this does not mean that it is without any flaws or disadvantages. There are some things that you should be really careful when you read through this financial statement, because there are some things that it might not reveal too clearly, and we will mention on these issues. Then we will explain the difference between cash flows from 3 different categories, which is cash flows from operations, from investing activities, and from financing activities. Now, as you know, every different company, whatever it does, is it a merchandise or whether it is a manufacturing company, or whether it is an insurance company, or whether it is a bank, they mainly involve in 3 different activities, and that is the operating activity, financing activity, and investing activity. Maybe you have already mentioned this. And the cash flow statement is the only statement that classifies the cash flows according to 3 different categories as the company itself performs its business operations. And that is a very important advantage for this statement. Next, we will try to learn how to explain the cash flow information, how to connect the information in the cash flow statement with the pieces of information that we already have in other financial statements. Now remember that the 4 financial statements should be interrelated to each other. You cannot prepare them as separated statements. They each have figures and numbers that they get from each other. For example, the profit and loss statement, the bottom line, the net result of the year, is the same that you find in the balance sheet at the equity section, the profit for the year. That means that all 4 financial statements sometimes have the same figures and same numbers. How is cash flow statement interrelated to the other financial statements? And we'll explain in this part. So what are the contents and the material that we'll cover? A brief introduction will be the first thing. Then we will try to make a distinction between the concept of profit and cash. This is where many people without an economic background have difficulty to understand. When we talk to a person who has not taken any economics course or knowledge, they may think that what they have in their pockets or their bank account, and that is cash, it is the same as profit. But after taking an accounting course, we know that that's not true. Profit is something else and it's different from the cash. cash reserve or cash balance. And we will try to cover that as a second thing. Then we will talk about cash flow reporting, when historically, when it was first needed to report and say something about cash flows. The other statements are pretty traditional. I may say that, for example, balance sheet has been preparing since 1800s, since the industrial revolutions. The companies by that time prepared the balance sheet, of course, not in the format that we find it today, but the notions are the same: assets, liabilities, and equity. Whereas cash flow statement is a pretty new statement. It was become mandatory to be prepared only in 1982 in US and in 1990s in Europe. So it's a fairly new statement than what is the necessary stuff needed and included in this statement. Requirements of IS 7, as it is a new statement, it also needed a standard to regulate and cover all the issues relating to this statement. The format of the cash flow statement, I mentioned that you will find different cash flows for different companies, but basically they are organized in the same way. All companies organize and categorize the cash flows under three classes, three categories: operating, investing, and financing. But inside them, you may find differences. But the format is the same. The preparation of statement of cash flows, whether it is with the direct method or with the indirect method. So as we said, profit versus cash, we mentioned that it's not the same thing. It may be the same thing for those who have not enough knowledge in accounting and financial reporting, but we know that that's not the case. We know that determining the profit and calculating the profit is complex and potentially misleading, and sometimes it's abusive. That means that you may have heard from many companies that they try to manage earnings or manipulate earnings. They are two different concepts. The earnings management means that you will try to use every tool allowed by standards in order to streamline and potentially increase the profits that you report and declare. That is, the earnings management does not violate any rules or standards, but still it is earnings management because you try to steadily increase the reported profits. Whereas the earnings manipulation is something really more serious than earnings management. The manipulation means violating some standards or some laws in order to report higher profits and mislead your potential investors. There are many companies in the history of financial reporting that have reported false profits, and they have gone into bankruptcy later when this was found out. And in later chapters, we will also discuss together about the tools for performing earnings management and manipulation. For the moment, we will just be enough to mention that profit is a very sensitive figure. It's something that may be easily manipulated because the profit is the difference between revenue and expenses. And remember that revenue and expenses are calculated according to accounting rules and accounting assumptions that you may change at any time. And by changing this assumption, you may change the expenses, and through changing the expenses, you may impact the profits. Okay? So this is why the profit is potentially misleading and or abusive. Of course, there are complete and incomplete transactions that may be involved in the process of miscalculating the profits. What we understand with incomplete transactions, maybe you have already known this transaction by the name adjusting entries. Did you get familiar with adjusting entries in the first part of the course or the pre-accounting course that you took? Now, adjusting entries are transactions that are not complete by the end of the year. They continue until the next year, or they fall into 2 or 3 different periods. And that is, you have to decide which part of the revenue and expenses of the transaction belongs to each year. If you decide that, you may decide something that is not correct according to the accounting rules, but that makes you increase your profit or decrease your profit, whatever your intention is. And that is what we mean by incomplete transactions. By having these transactions, we may impact very easily the amount of profits. You have some examples over here. Complete are those transactions that have finalized cash settlement. That means for which we have already paid or received money. And there is no problems in profit determination regarding complete transactions. Whereas incomplete transactions are those that are not related to final cash settlement. For example, you have taken an advance from your customer and you will provide to this customer services and products later, but you will receive, of course, the second installment of the payment later from this customer. Also, incomplete transactions are the various estimations according to the accruals concept. Anybody can explain in simple words what accrual concept is? This accrual accounting versus cash accounting, I know that you know that. With simple words, what does that mean? Because this is crucial for this statement. Remember, this is the cash flow statement. It is based in cash accounting, whereas all the rest of the statement, balance sheet, profit and loss, and so on, they are based in accrual accounting. So this is a difference in methodology over here. And this is sometimes the source of difficulties with this statement. We have to change the settings in our mind from accrual accounting to cash accounting. Now, what is the accrual accounting? With simple words, somebody maybe.
Record the accounting before I have collected the cash, but based on what happened, like not basically by the cash, but what happened in the situation, we have to account that immediately.
Okay, that is a good explanation using your own words, and I like that. I want you to all to do that, to try to express yourself. It's a good start. Now, accrual accounting means that I will record transactions, being them expenses or revenue income, not when I receive money or when I pay money, but when the transactions really happen, really gives effect. Maybe I spend something, I have not paid for that expense yet, but the spending has given some effect or impact in the company. Or maybe I have generated an income. Maybe I have not collected money, but I have sold some inventory to customers. They will pay me after 2 weeks or 2 months, but that does not mean that I have not sold this inventory. I ship the merchandise to customers. It's in their warehouse right now. So this means that the transaction has happened. I will collect money after 2 months, or if the customer go bankrupt, maybe never, but the revenue is generated. So accrual accounting basically is saying that you will measure the effect of transaction when they really happen, not when you are going to collect or pay the money. And this is required from all companies all over the world regarding financial statements to use exactly the accrual accounting concept. That is not true about cash flow statement, as you may imply from the name itself. This statement does not measure the effects of transaction when they happen. It's not really important for this statement. This statement focuses on cash flows only. When did you collect money? When did you pay your money? It doesn't matter if it is related with the transaction for this year, for the future years or previous years. It is related on cash flows only. So the difference between two methodologies in accounting brings the difficulties in preparing this new statement over here. Also, an example of incomplete transactions are sometimes the assumptions, that we have to do and make about the future. For example, the expected life of an asset. You have discussed the depreciation of long-term assets, machinery and equipment, and you have already discussed that if you prolong the expected and useful life for assets, the amount of depreciation expenditure will be lower each year. Okay? So, if you lower the amount of depreciation each year, this means that you will have higher profit. This will have an impact on the profit, but not on cash. Why? Because depreciation is not a cash expense, is what we know as a non-monetary expenditure. Depreciation is rather, as we mentioned also yesterday, is rather an allocation of the historical cost over the years of using the asset. The cash outlay, the cash outflow has already happened in the moment when you purchased the machinery. Now you are not paying again. You are just allocating a purchase that you made maybe 10 years ago. That is, if you change the expected life of an asset, cash is not affected. Why? Because you already paid for this machinery 10 years ago, but you may impact the profit. And this is what the companies usually do. They use the allowances within the standards to impact the profit. They are not violating the standards, as you can see. They are just making new assumptions for the expected life of assets. That's pretty okay. Managers are allowed to do that. Actually, they are encouraged by the standards to apply their own assumptions for the expected life of assets, but you see that this becomes a way for them to abuse with the amount of the profit. This is just a simple example to let you know that actually the profit is an easily manipulating figure, and you should be very, very carefully when you read the amount of profits in the financial statements. That may have been impacted by the incentives of the management, whereas the amount of cash is not affected by anything. You cannot lie about cash. Cash is either received or paid. You cannot change that. That is easily verifiable through bank transactions, cash income and cash outlays. You cannot lie about that. But regarding profit, of course, you can change that by a simple procedure like this that we are mentioning here. Simply assuming that maybe this computer will not last for 2 years, but for 5 years. If you spread the life of this computer over 5 years, the amount of depreciation each year will be lower, the profit will be higher. And then what happens if you report higher profit? Usually the impact in the perception of the investors in the stock market is such that higher profit companies will have higher prices in their shares and stocks. And that is why many companies are incenting to increase their profit. Okay, I think the issue was made clear, I hope. So why profit and cash are not the same thing? Why cash is important? Because it's a figure that we cannot change in any way. And be careful of the profit amount, because that can be easily changed and manipulated by companies. Now here is an example with figures and amounts, just to let you know how the company may have different effects for profit and cash as well. For example, the statement A, as you can see, it's an example of the profit and loss statement. When you say profit and loss statement, usually we expect to find items like sales, less cost of sales, less other expenses. Focus on statement A, please. Less depreciation, less taxation provided, and then we have retained earnings. Now, the way the company has calculated each item, like sales and cost of sales, it follows the standards. To calculate the sales revenue, we have IFRS 15. IFRS 15 decides the rules that I have to follow to recognize revenue, okay? And also, cost of sales, we have to follow the matching principle in accounting. As much as I have recognized the sales revenue in the first item, the matching expenses I have to recognize in the cost of sales over here. So recognizing each item in the profit and loss statement relates to the application of the IFRS and IS rules and requirements. Whereas on the other statement, which is a simplified version of the cash flow statement, actually the cash flow statement is much more full of information than this, but this is very simplified. We are focused only on the cash proceedings from each transaction. For example, sales are 410 cash units, whereas sales received are only 387. What might cause the difference between two figures? You may think of a reason that these two may not be the same. Remember, you are a future manager, your accountant will come and bring these figures to you, and he will say, okay, we have sales, imagine these are millions, we have sales 410 million, but sales received are only 387. Now, the accountant may have done something, and you should be really careful to know what. What may cause the difference?
Matching concept?
In order to not jump into conclusions that he had misappropriated this part of assets, what may have caused the difference?
Matching concept?
Matching concept, not yet. We are at the first line over here. The keyword is sales received. What does that mean?
Account receivable. They didn't pay us.
Yes, we have to check the accounts receivable. What are the accounts or trade receivables? It's the same thing. What do they represent?
They didn't pay us.
Where is this voice coming from? Okay, the masks. Okay, they didn't pay. They have not paid. Part of our customers have used the allowance that we have already provided for them to pay later. That means that each time that you sell merchandise, you loan your customers 2 weeks or 1 month or 2 months. It depends on the company. And many customers use this credit opportunity for them. And probably they have not paid the money yet. Now this is a very simple reason for the difference, and actually this is the truth and reality for many companies. And you should be aware that in no company it can be the same, the amount of sales and sales received. It's almost never the same. Why? Because you always have customers that use their credit allowance and they will pay us later. Okay? Now the problem belongs to the cost of sales. The cost of sales is 329, whereas you have paid more, 333. How is that possible? Again, before judging or misjudging the accountant, I know that accountants are often very criticized, and they should be actually, but before we think bad of our accountant and chief financial officer, let's think what may cause the difference. How can we pay more than we have spent?
The costs that we didn't calculate in the cost of sales, like administrative costs and other costs, all that cash is cash?
Not yet. This is cost of sales, and that is payment for goods sold. All the administration and things, they are not included there. Let's assume for the moment.
Maybe we have prepayment.
We have also some answers in the chat, and we have some answers here as well, which is basically the same. Maybe we have prepayment. We have made prepayment for the future year, and that is a common transaction procedure for many companies. I agree with Ivan, and I agree with your colleague over here. Maybe we have not only paid the cost of sale for this period, but we have paid something in advance for the future. These are known as prepaid expenses. Maybe you have heard about prepaid expenses. Usually prepaid expenses are prepaid rent or prepaid insurance, but not only. It may be prepaid inventory. You give advances to your suppliers and you will receive the merchandise and inventory later, okay? This may be one reason. Another reason that I may think of, and which is even more common and usual, is that we have not prepaid for the future, but maybe we have paid for expenditure of the previous year that we didn't pay then. Okay, you remember those customers that delayed their payment of their invoices? We may do the same with our suppliers. Maybe in this year, 2021, we are paying some of the bills of 2020 that we didn't have money by them, but now we have. And we are paying later some expenditure of the previous year. So to summarize, sometimes we pay more than we spend. Why is that so? Because we may pay some of the expenses of the previous years that we didn't pay by then, or we may pay for some of the expenses of the future year, next year, that we want to pay in advance, or we are required by our supplier to pay in advance. Okay? You see that almost nothing is the same between the two statements. For example, you have here less other expenses, 36, whereas the other statement is other expenses paid. You see the crucial word is either received or paid. In the cash flow statement, the concepts are related to the cash inflows and outflows. Either we receive money or we pay money. You see that other expenses paid are less than other expenses. Again, what may be the reason for this? Let me add that at other expenses, there may be included administrative expenditure that your colleague mentioned here, or there may be salaries for employees, or maybe it is the electricity bill, something like this. Maybe you have received the invoice, and therefore you have recorded in the expenses, but you have not paid it yet. So it's not included in the expenses paid. And that is the case with many companies. They collect invoices, but usually they take some days or even some weeks before they pay them. At the end of the year, they make a calculation how many invoices we have received, and that is our expenditure, and how many have we paid. This is the amount of expenses that is paid. Okay, you see here a very interesting confrontation, and that is very crucial for cash flow statement. On one side, we have depreciation, and then we have capital expenditure. Now we have talked over and over about the depreciation, and we have mentioned that depreciation is a non-monetary expenditure, meaning that when you say depreciation, you are not paying anything because you have already paid for that equipment, you are just allocating the purchase price over the years, okay? So normally, under the profit and loss statement, I would find the depreciation figure item there. But you see, on the other statement, it's not the term depreciation paid as I was expecting to find it. You see, for the previous items, it is sales received, expenses paid, cost of sales paid. Now it's not depreciation paid because it's counterintuitive, but it is capital expenditure. Any of you can explain with simple words again with what capital expenditure are? It's simple. Again, something that we have already covered in the previous part, first part of the course. Investments, but there are many kinds of investments. Investments where? In which item? Investments in stock market? No. So let's clarify. Capital expenditures are investments in machinery, equipment, or in other words, plant, property, and equipment. Long-term, tangible assets. That means that what you are paying related to the machinery and equipment and long-term assets we recognize by the name capital expenditure or investments in tangible assets.
Sorry, Professor.
Yes?
Can I ask, that investment is all the amount of the investment of machinery, or it's like depreciation with every year?
That's a good question. This capital expenditure here does not represent depreciation of the year. Depreciation of the year is over here, 13. Capital expenditure does not also represent the total investment in property, plant, and equipment that is to be found in the financial statement position in the long-term assets. The capital expenditure is only the increase in historical cost of property, plant, and equipment for the year. That is, the capital expenditure represents what you are paying for purchasing new property, plant, and equipment only for the current year. The overall machineries that you are owning, they are in the balance sheet, non-current asset section. Whereas capital expenditure here just represents the increases for the year, what new machineries you are purchasing. Okay? Is that clear now? Thank you for asking. That made really needed clarification. Okay, you can see also further items down there. Taxation provided and taxation paid. Of course, we have differences here. We may pay more taxes than calculated because we may also pay taxes for the previous year or for the future years. And also the dividend, the same thing. We may assign or report some dividend and then we may pay a different amount. Now, this is a comparison, very good comparison, just to draw our attention that the amounts are to be different between different statements. In the profit and loss statement, we have the amounts for revenue and expenditure, whereas in the statement of cash flows, we find the related cash effects, cash inflows and outflows. Never, they can be the same, but we have to know why this difference is caused. Okay, so cash flow reporting, before we continue, can you please open the window? The window over there, sorry, can you open the window? The secretary came yesterday and she specifically asked that we kept our windows open. Does that bother anyone? Is that okay with you? Can you do that? Okay, because the secretary thought it was like a procedure for COVID measures, keep windows open. In case it bothers someone, let me know and maybe we can close for short periods. Okay. So we are jumping into the next topic right now, which is cash flow reporting. When people mention this term, cash flow reporting, sometimes they are too broad in their concept, they are not very specific what they exactly mean about the cash flow reporting. But it is important for us to understand various situations and various needs for using the cash flow statement, and to also separate arguments from one another. Cash, remember, represents increases or decreases in business resources, and it is argued that only cash should be reported. Sometimes reporting only the cash, the reserves in increases or decreases of cash, it's a good thing, but usually that means that we are following only the cash accounting principle. And we have previously argued that following or abiding to cash accounting principle only, it's not a good decision. It's not enough to report the real results of the operations of a company. So just focusing on cash flow reporting, it's not a good and a wise thing to do. Of course, cash flow reporting adds value to the overall reporting of the company, but it's not the only component. It does not say everything that happens within a company. Therefore, we may mention that cash flow reporting gives us no indication about future cash flows, and we may have an idea what has happened in the past with cash inflows and cash outflows, but that does not specifically help us to understand what will happen in the future cash flows. If we are going to meet our future debts or not, that is not something that we can foretell or forecast definitely by the cash flow statement alone. And also, on the other hand, on the other side of the coin, let's say, the other side of the story, focusing on the profit and loss statement or the income statement, this is not a good indicator of cash potential for a company. On the other side, the cash flow statement is not a good indicator of profit. What we are trying to say here is that both statements are important. The income statement and the cash flow statement, they are like two sides of the same story, like the two sides of the same coin that try to complement each other. Like you saw in the previous slide with the comparative statements over here, you can see that by reading both statements, you can understand the income or the result side of the story, and also you can know also the back side of the story. Okay, what are the effects of revenue and expenditure on the cash potential of the company? So, of course, the two statements are important, but only if you use them interrelated or as a complementary tool with each other. If you use them only to argue that one is better than the other, that is not going to be very effective or informative. Let's go at the requirements of the standard itself after presenting in general some concepts related to cash flows and cash flow reporting. What does the standard say about the cash flows? The scope of IS 7 is to, first of all, to be applied by all companies, by all enterprises. IS 7 does not exempt any of the enterprises. That means also the insurance company, financial institutions, banks, which are very specific industry and enterprises, they also have to prepare the cash flow statement according to this standard. So even the banks have to report operating activities, investing activities, financing activities, even though that for a bank, operating activity is very different than for a manufacturing company. For a manufacturing company, the operating activity is buying raw material, manufacturing and selling finished goods. Whereas for a bank, the operating activity means gathering funds from deposits from clients and then offering loans and debts to other clients. That is the operating activity of a bank. But still, the banks consider that an operating activity. And it's not excluded by the application of this standard. So no exceptions. Generation of cash flows and definitions is divided in these broad categories that we find here. Operating are the principal revenue producing activities. Or to put it in simple words, operating activities are those transactions that are not categorized neither as investing nor as financing activities. Now remember that some moments ago I drew some parallels between manufacturing companies and banks. Remember that for manufacturing companies, operating activities are principal revenue producing activity. What is that produce revenues for manufacturing companies? Obviously, buying raw materials, manufacturing, selling finished goods. For banks, what is principally causing or bringing revenue? Collecting deposits, offering loans, okay? Now remember, insurance companies, if you can offer an answer here, we just mentioned and covered insurance companies yesterday together. What would you think the operating activities are for insurance companies? Remember, operating activities are the primary source of generating revenue. What is generating revenue for insurance companies? Okay, we have some answers in the chat. Thank you for following me very attentively in the chat. Maybe here in class they are shy, or the other reason you are not answering is that maybe these questions are too easy for you. Okay. So you can see the answers from other students, right? The primary generating activity for insurance companies is selling insurance contracts and receiving premiums. So when we categorize the activities of an insurance company, we will include in the first category, the operating activity, offering or selling insurance contract or receiving premiums, in simple words. Thank you. Raw materials are related, of course, to the manufacturing companies. Let's continue. The other class, the other category is the investing activities. A simple definition is that in this category, I will include all those transactions that involve acquisition or disposal of long-term assets and investments that are not included in cash and cash equivalents. In other simple words, investing activities means every time I buy new machinery, every time I buy a new building, every time we buy new plants, or every time we sell existing machineries or we dispose them, that means that these are all investing activities. So once again, what is investing activities is a transaction that changes the structure of investments of companies. Investments are usually tangible, but also intangible, patents and licenses and goodwill. The third category of the cash flow statement is financing activity. These are activities that result in changes in the size and composition of the equity capital and borrowings of the enterprise. Now, with simple words, financing activities are including every transaction that changes the financing structure of the company. Each time that you sell new debentures or issue new shares, each time that you take a new loan, or on the other side, each time that you repay the loan, repay the debts, or take back the shares and bonds from the market, all these transactions are considered to be part of financing activities. So remember, there are three main categories in the cash flow statements. Operating activity will gather and summarize everything that is primarily generating revenue from the company, whereas investing activity will gather and summarize all the transactions that change the investing structure of the company every time you change the amount of tangible or intangible assets. Financing activity will summarize everything that changes the financial structure every time you issue new debt or retire the existing debt. That means that you are paying or receiving money. You will include that in the financing activity. Now, if you may think for these three activities, you may also have noticed that many transactions are usually part of the first category of the operating activities. Many cash inflows and cash outflows that a company deals with actually belong to the operating category, operating activity. And few transactions, very few I would mention, are part of investing or financing activities. Now imagine the everyday business life of a certain company, of Carrefour, for example. On a daily basis, Carrefour would buy stuff, merchandise, and would sell that. That is part of operating activity. That is what happens daily. Whereas investing and financing, that happens very rarely. Investing, Carrefour will not buy everyday new plants. Actually, they do not have plants, or transport machines, transport vehicles. They will not buy them every day. Maybe they will buy once a month or twice a year, but not every day. So investing activities does not happen on a daily basis. They are less in number, and it's very easy to analyze for them. Also, the financing activities, they do not happen on a daily basis. Carrefour is not likely to go in the stock market every day and issue new shares or retire the existing shares. This happens really very rare. And that means that the most problems you will have with preparing a cash flow statement is with operating activity. That is, that really gathers the more volume-related transactions. Rarely the companies have as many transactions in investing and financing. So please be focused on the operating activities, because that will be like the more difficult part of preparing a cash flow statement. Something else that I need to say, whenever you are not quite sure where to include a transaction as operating, investing, or financing, please remember that investing is very specific. The transaction included in the investing activities usually impact the section of non-current assets in the balance sheet. Whatever happens that changes the items in the non-current asset section in the balance sheet is going to be included in the investing activities. Whereas the financing activities is whatever happens that changes the items in the non-current liabilities and equity section in the balance sheet. Whatever transaction happens that makes you change the amounts of non-current liabilities and equity in the balance sheet is considered financing activity. Everything else that is not investing or financing, it will be operating activity. This is a simple way to memorize where to put everything. The biggest problem with cash flow statement preparation is where to put each transaction. Where does it belong? Is it operating? Is it investing? Or is it financing? Remember this, if these things that is happening is changing non-current assets, is investing. If it is changing non-current liabilities or equity, is financing. If it is neither investing or financing, it is always operating activity. Now, having these general broad rules in our minds, I hope it will be easier to continue with details that is provided by the standard. This is like general categorization of transaction, operating, investing, or financing. But in case you have doubts for certain transactions, actually the standard has provided some guidance, and let's have a look at them. We mentioned the cash principle. Okay, I have to make a correction in this slide, in the title. You see that general or usual transactions to be included under operating activities, investing activities, and financing activities. Remember the rule that I mentioned? Investing activities are everything that will change the amount of an item that is part of non-current asset. And you can see for yourself the transactions here. Cash payments to acquire fixed asset. Now, if you buy fixed asset, that will increase the amount of fixed asset in the balance sheet. Cash receipts from sale of fixed asset. Whenever you sell a fixed asset, you will receive some money, and this represents very well the cash receipts or the cash inflows. Cash payments to acquire equity or debt instruments of other enterprises. This is, in simple words, investment in securities of other companies. Cash advances and loans made to other parties. Be careful. This is loans, not loans received, but loans made. Loans extended to other parties. If it is loans received, it is a financing activity. If it is loans extended to other parties, to other companies, it is investing activity. Okay? Then we have cash receipts from the repayment of advances and loans made to other parties. All the time these other companies repay the loans, we will have money back. It is a cash inflow for us, and this is part of investing activities as well. Whereas part of financing activity, you will see the common transactions that I previously mentioned. Cash proceeds from issue of shares and other equity instruments. Cash payments to owners. Cash proceeds from issuing debentures. Cash repayments of amounts borrowed. Cash payments by a lessee for the reduction of the outstanding liability that is related to a financial lease, and so on. Everything that is not investing or financing, that is, it is related to the daily procedures of the business, such as cash receipts from sale goods or rendering services, cash receipts from royalties, fees, commissions, other revenue. For example, we may rent some of our buildings and we have rent received this is included as operating activity. If this is a primary source of income for us, of course. If it's not, it will be investing. Cash payments to suppliers for goods and services, and also cash payments for employees or salaries paid. Cash payments for taxes or taxes paid. Cash receipts and payments for contracts held for dealing or trading purposes. That is the primary reason of the business. If it is not the primary source of generating revenue, cash receipts from trading securities will be categorized under investing activities. So again, this is a common categorization of transaction under each of the three activities in the cash flow statement. Any questions so far? Okay, we have a short break now, 5 to 10 minutes, and then we continue.
现在是很累啊，感觉。
我到今天早上还在反胃酸，超惨。但我昨天睡的其实还好的。
睡一会儿，喝点，实在不行就喝点胃药。
我有好多胃药，已经很久没有这样，有可能最近一到天气凉，再加上嗓子应该是我感觉有点上火的，但是感觉有一点磁性的声音。
这个时候阿边都在的话，应该聊聊天。
可惜了，他不在。
亲爱的，你有我有5块10亿来着，你有5块的硬币。
有点困难。
你也没有。
应该不太会有这么多的硬币。
都只需要硬币。
我给你拿一个，我们去喝，你要去喝那个机器的吗？
就买那个水，我的水。
给你拿这个用。
不，宝贝，我去那个换一下吧。
换着多费劲，你就先拿这买呗，到时候再说呗。你还请我喝咖啡呢，等我们喝咖啡去。
那个没事了。
你等我看一下这底下啊。我又找到5毛。
没事。
他不一定会给你换呢，我猜。
真的。
对，因为他们想留着零钱。走吧，先暂停。
对。
Financial statements actually had previously categorized the, let's say, revenues or income or expenses according to this kind of classification. The cash flow statement is the only one that does that. So we also mentioned what kind of transactions are included in each activity: operating, investing, and financing, and there are some special considerations that need to be taken into account for those transactions that we may be a little doubting where to include them. For example, the interest and dividends received and also paid, according to IS 7 paragraph 31, they may be classified as either operating, investing, or financing, provided that they are classified consistently from period to period. That means that you have freedom to categorize them in either of the activities, but with the only condition that you continue to do so over the years. Will not change and recategorize them in another class later. Another thing to remember is that the cash flows that arise from taxes on income are normally classified as operating. Usually we may think of taxes as to where to include them. What are these transactions usually? And paragraph 35 of IS 7 specifies that usually the taxes will be considered as operating transaction, operating activity, unless there is an indication or explanation that these taxes can be specifically linked and identified with some investing or some investing activity. Now remember this mini table, this little table over here, it is very important because it gives you indication where to put, where you are allowed to include the interest and dividend either paid or received. Now remember that paid or received, they come from different resources or for different reasons. I will start with the interest paid. Usually we pay interest on loans or on debts. As the loan or debts or bonds and debentures are part of financing activity, therefore you may have an argument in favor of including interest paid under the financing activity. You may think that as the debts and liabilities like loans are part of financing, the same should be also the interest paid. So this is an option that you have. Interest paid will be part of financing activity, but IS 7 also allows you to include interest paid in the operating activity. This is usually made with the argument that usually we receive loans and debts not for the sake of having liabilities, but for the sake of performing and helping the operating activities. Therefore, I receive some loan in order to supply money to my main business operation, that is the operating activity. And therefore, the cost of financing should be borne by the operating activity. That is why the IS 7 allows you to either include interest paid as financing or operating. Okay? The same, yes. Question?
So what is the final outcome?
Sorry?
What is the final outcome if I just put
You may choose whatever you want, as you know. Okay, class, for whoever just joined us, we are discussing about specific requirements in IS 7. We have those broad categories, operating, investing, and financing, but there are special considerations. And one of them relates to interest and dividend paid and received, and the other one is about the income taxes, for which we are going to talk later. Now we start with interest paid, and I explained that IS 7 allows you to do whatever you want. If you want to categorize them as financing, that's fine. It is allowed under IS 7. You are not violating the standard. If you decide to include interest paid under operating activities, that is also fine. You can do that. Only with the condition that you continue to do this over the time. You are not allowed to change the treatment of interest paid from one year to the other. That means that if in 2020 you have included interest paid as part of operating activity, you cannot suddenly change that in 2021 and include interest paid under financing activity. That is, you should be consistent with the treatment and representation of this item. Does that make sense, or does that answer to your question? Sorry? No.
No.
Can you repeat your question again, please?
My question is, what is the outcome of if I put it in the operation or financing? For example, I categorize my the interest paid in the operation sector or the finance.
Okay, what is your outcome?
What is the outcome of that?
Okay, this is why the standard allows you some alternative treatment. You have seen this not only at IS 7. If you have been attentive, every financial reporting standard offers you alternative treatments every time. I mentioned yesterday, for example, the treatment of fixed assets. You can account for them either with amortized cost or fair value. You can choose whatever you want, with the only condition to apply this consistently. That is the same thing here. Now, what is the outcome? That's not an easy question. The outcome depends on the decisions of the managers. I would think of myself, if I was the manager or chief financial officer of a company, I would rather include interest paid on operating, because that makes more sense. Because of the argument that I mentioned, we usually receive loans to finance the operating activities. Again, this is for the managers to decide. What I also have noticed is that usually it is included in operating activities because that makes the company look more stable in the cash flows it generates. The operating activity has more capacity to support the interest paid, if you know what I mean. If you include the interest paid in the financing activity, it would make the financing activity even higher negative figure, and that is not good when you look at. Whereas if you include interest paid under operating, the operating usually is positive and it has some capacity to support some outflows, if that's clear.
Yeah.
but I think it will become clearer later. That is, the standard allows you two options, and you, for yourself, for your company, may decide which category has more capacity to support some outflows. Okay, you also have a question, I guess? That's a question, yeah?
No, with my understanding is that we can choose either we can put in operating or financing too, one of two.
Of course, one of two, not twice.
I think because I thought like we have to put in also in operating, also in financing.
Sorry, this is or here in English. This means either or, either here or there.
Okay.
I'm not a native English speaker, neither are you, but I think that that particle there or, it's pretty clear that you cannot double report an item. You can either include in one category or the other, not doubling it, not representing it twice, okay? Maybe this was your question after all? Yes?
No.
Yes?
No. Okay. My question was the first one.
The first
one
one?
you just
Did I
described.
answer your
Yes,
question?
Yes.
So, once again, to summarize, you can either include in one category or the other. That depends on your own judgment of the activities of the company. The standard accepts that there are arguments in favor and counter to each of the categories, so you can choose. The only condition is that you continue to do this in a consistent manner over the years. The same thing you can see it's true about the dividends paid over here. Interest paid and dividends paid are or have similarities to each other. We pay interest on loan, whereas we pay dividends on what are usually dividends paid on. Why do we pay dividends? What are dividends? That's a very interesting term in finance and accounting. What are dividends?
Profits for shareholders of company.
Yes. They are part of the profit of the company that is distributed or it's allocated to the shareholders. Be careful, dividends are not expenditures, they are distribution of profits. Shareholders will receive dividend as income, whereas from the perspective of the company, dividends are distributions or appropriations or allocations of profits. Be careful, they are not expenditures, okay? Now, when we consider dividends in the light of the cash flow statement, we have the liberty to include them either as part of operating activities or financing activity. So the same treatment as interest paid, because basically they are cost of financing, but not cost of financing through debt, but cost of financing through equity. That means that if the company has decided to issue shares, the cost to support the equity capital is to appropriate or to distribute dividend. That is, it is very, very logical to include dividends under financing activities, but also, like the interest paid, you may choose to include dividends paid as part of operating activities in case you think it is more logical to include dividends as part of this operating activity, because at the ultimate reason you have issued shares and stock to support the operating activity, not for the sake of opening a company for itself. This is the basic logic behind that. You also see the same treatment regarding interest received and dividends received. You see they are both allowed to be included either as operating or investing activities. Now, what is interest received? Interest received relates to different investments that you have been making. You either have a deposit in the bank or you have purchased stocks and shares from other company. From whatever investment you are making, you may earn different interests. For example, you have a deposit in the bank and you receive the interest on this deposit. The deposit itself is part of investing activities, as we previously mentioned, because having a deposit in a bank, it's a financial instrument and is part of long-term assets. That is, any interest that you accumulate and earn on this deposit is going to be part of investing activities. The same treatment is allowed also for dividends received. You usually receive dividends every time you make an investment through buying stock or shares of other companies. Suppose you are deciding to invest the free funds that you have as a company, buying stock or shares of a known company in the stock exchange, Alphabet company or Google company or IBM. That means that you will receive at some point dividends as return from this investment you are making. That is dividends received. As it is related with an investment, it is logical to include dividends received as part of investing activities. Okay? But also, as we mentioned before, the standard allows for the 4 items if you choose to include them in the operating activity. The common logic behind that is that whatever investment you are making, whatever financing you are deciding to make, that is not for the sake of investment and financing itself, but it's for the sake of the operating business. Your primary reason to exist as a company is the operating activity. And you do whatever you do, either investing or disinvesting, either financing or disfinancing, you do everything for the sake of the operating activity. That is, whatever result you have from investing or financing, you may choose to include in the operating category. I really hope that is clear, because this adds to the variety and diversity of different cash flow statements between different companies. Remember, interest paid and dividends paid have the same treatment, either operating or financing. Interest received and dividend received have the same treatment, either operating or investing. Whereas the cash flows that relate to taxes, they are usually included as operating. In very rare circumstances, when the company have very good arguments, they can be included either as financing or investing activities. We also have some references to the specific paragraphs of the standard itself that mentions where to classify each of these specific transactions. Sorry. I think that we disconnected again.
I'm sorry. 对。
Okay, we are good. Can you hear me all right? Sometimes we have problem with WebEx. Can you hear me all right in your online connection? Thank you. Okay. So we can also continue with specific considerations that we are making of IS 7. This is some specific example of different common transactions for a company and their categorization, where to include them, in which category in the cash flow statement. For example, when we mention the first transaction, the purchase of vehicle, this is operating cash flow. This is purchasing motor vehicles for sale, and it is going to be included as operating because motor vehicles are not going to be used in producing or manufacturing anything. They are going to be purchased only for resale, and therefore it is operating. Whereas if we purchase motor vehicle to use in the delivery, that is going to be an investing cash flow. On the other hand, if the same motor vehicle is going to be used as a finance lease, that is going to be included under financing cash flows. That means that usually the same transaction made for different purposes, it's going to be categorized under different categories and activities of cash flows. The use of motor vehicle under an operating lease, for example, is again an operating cash flow. You see, it's the same motor vehicle, but it is used for different purposes. okay? We also have mentioned again the treatment of the interest paid and received and dividends received, and also dividends paid by an organization. Please be aware always for the purpose that the company makes a certain transaction. It may be the same, but for different purposes, it may be categorized under different categories, as you may see. Something also important about the IS7 is what we can include in cash and cash equivalents. We have three categories, of course: operating, investing, and financing. But whatever we don't include in each of them can be regarded as cash and also cash equivalent. Now, the term cash is very broad. It may include cash in hand and bank accounts, or also some deposits that are very liquid, have a very short term of maturity. But we also have the term cash equivalent, some items that are nearly cash or almost cash. So first of all, cash includes cash on hand and deposits on demand, whereas the cash equivalents represent short-term or highly liquid investments that are readily convertible to known amount of cash and which are subject to an insignificant risk of changes in value. That is, all those deposits or short-term investments that you can turn in cash almost readily without losing any part of this deposit as a charge or penalty or fee from the bank, and also without even noticing the bank. So again, you may have many kind of deposits and accounts in the banks, in various banks. Not all of them are included as cash equivalents. Cash equivalents are only those deposits for whom you do not need to make a notice in the bank to retrieve the money. You can just go there and take the money back. And also, the bank does not charge any penalty fee for these deposits. They do not keep a certain amount of the deposit as a penalty or a fee or a charge for retrieving the money without a notice. All the deposits and accounts that fulfill these conditions are known or are called cash equivalents. They are almost cash. You can have them at any time you want without the risk of losing any part of this investment or deposit. Another thing is that usually cash and cash equivalents are very short term, and when we say very short term, they are up to 3 months or less. Anything that it is above 3 months, a deposit for 6 months usually is not cash equivalent. Also, what is to be mentioned regarding cash equivalent is that an investment could therefore be considered either cash or cash equivalent as investing as well. This means that something that I decide not to include in cash equivalents very well can be part of the investing activity. Let me make an example. Some deposit that has very liquid features is part of cash equivalent, but another deposit for which I have to make a notice to the bank before I retrieve the money, that is not a cash equivalent, but still it is an investing activity. It represents an investment for the company. So everything that is not part of cash equivalent because it is not readily available, it cannot be readily converted to cash without losing any part of the money or any risk, that means that still it is part of the investing activities of the company. Usually requirements of IS7 can be represented, summarized in this table. As cash equivalent, we will regard all the accounts that are held with the bank for less than 90 days. As we said, for less than 3 months. Whereas if we have an account in a bank for slightly more than 3 months, for example 95 days, that is not a cash equivalent anymore, but it is an investing activity. You see, there is a very thin line that divides the deposits or accounts in banks. Either they will be categorized as investing if they are more than 3 months, even for 2 or 3 days more than 3 months, or if they are less than 90 days, they will be part of cash equivalent. Remember that also overdraft, you know what overdrafts are? It's a common business practice when we operate with current accounts in bank, and sometimes the current accounts become negative, so we retrieve more money than we have in the bank. This is known as a negative balance in the current bank account, or otherwise as an overdraft. Okay, thank you, that's exactly what it is. So every time you notice an overdraft, how can you notice an overdraft? Every time you look at the balance sheet and you find the bank account not as part of assets but as part of liabilities, even though it is not named there overdraft, that is an overdraft. So it has not the name overdraft, but every time you find the bank account on the liability side, that is an overdraft. Okay, and in this case, it's going to be a cash account or part of cash, but if you have not an overdraft but a loan for 60 days, for example, for specific purpose, that is a short-term loan also, but still it's a financing activity, it's not a cash account or cash transaction. So every time you have loans or debts, even for short periods, like 60 days, that will be part of financing activities. The same thing with investments. If you are investing in trading securities, buying stock in the market, even if it is a fluctuating market with many changes in the stock price or share price, this investment is going to be part of investing activity and not cash account. Now, this table is really very useful to know where to put each transaction if you are not secure. Is this deposit cash or is this investing? Now, if this deposit is more than 90 days, it is investing activity. If it is less than 90 days, it is part of cash equivalent. Whereas loans are usually part of financing activities, even if they are short-term loans. So I hope this is useful for referring to later. Okay. Let's jump to the format of the cash flow statement. How can we prepare the cash flow statement, and how is the layout, what we can expect to find when we check and look the cash flow statement itself. Usually the cash flow statement is designed in 3 different sections. And whatever information you read about the company, you should try to put in the correct section, where it does belong. The first section is cash flow from operating activities. We vastly mentioned all the transactions that are usually included in this activity. I'm not stopping there for longer. The second section is cash flow from investing activities. Again, it will include all the transactions that will have an impact on the investing structure of the company. And the third one is cash flows from financing activities. Everything that happens, every transaction that changes the financial structure will be included in this third section of the cash flow statement. Then we have what is known as the equation of the cash flow statement. I think that you know that every financial statement has its own equation, right? The balance sheet, famous accounting equation is assets are equal to liabilities plus equity. Who can say the equation of the income statement? As always, it's simpler than you may think of. The equation of the income statement is revenue less expenditure. Expenditure is equal to profit. The equation is the fundamental link between different items in a financial statement. What you want to represent in that statement is summarized in what we know as an equation. That is when we say balance sheet represents the equation assets are equal to liabilities and equity. And this is when we say income statement represents the equation, the fundamental equation, revenue less expenditure are profit. But when we come at the cash flow statement, what is the inner equation that we want to express through this statement? Actually, what we want to say is that the sum between cash flow from operating activity, we will recognize by these acronyms as CFO, plus cash flow from investing activities, CFI, plus cash flows from financing activities, CFF. The sum of three of them should always be equal with net change in cash and cash equivalents. The equation of the cash flow statement is a very crucial moment for your work to check if you have been correct and accurate in the preparation of the cash flow statement. After you calculate cash flows from operations, cash flow from investing, and cash flow from financing, and add them three together, if the sum of them is equal to the change of cash and cash equivalents in the balance sheet, you have been correct and accurate. In case it's not, something has been left out. There is some kind of mistake that you may have made. Maybe one transaction has not been included. Maybe one other transaction has been included with the wrong sign. Maybe one transaction has been included twice or has had a double effect. So there may be many reasons why ultimately the sum of the three cash flows are not equal with the net change in cash and cash equivalents. But remember, this fundamental equation of cash flow statement is really important to check your work, if you have been accurate or correct or not. After you do all the job of preparing a cash flow statement, when you find that it is equal with a change in the cash amount, you can feel confident that you are alright, you are correct, you have not made any mistake. And we will see that for ourselves when we try to prepare a cash flow statement later. Now, what is the format of cash flow statement? It is separated in several parts within these three sections that we mentioned: operating, investing, and financing. Each of them has some special part or category that we have to become familiar before we try to prepare a cash flow statement. For example, we have to mention that when we talk about cash receipts and cash payments from investing and financing activities, we are referring to the gross amounts, not to the net amounts. That means that we are not allowed to net off different transactions that come from the same source. For example, if we have paid money to the same supplier from whom we have also received some money, we have to show the gross transaction to the same party, not compensate or net them off towards each other. That is the principle of showing the gross amounts in the cash flow statements. Also, when we mention gross cash receipts and payments from operating activities or net profit, adjusted for effects of non-cash nature, cash flows under any of the three sections of the cash flows can be reported net only in those cases when really the intention of the company is to reflect that this transaction actually will be compensated. So that is that we are not compensating the payment and the receipts only on paper, only for the sake of the statement, but that really that should happen or will happen, in fact, with relation to this customer or to these suppliers. Okay, that is something that will become clearer throughout the solution. Also, cash flows relating to extraordinary items should be identified separately under each category. Actually, this paragraph is an outdated one in IS7. IS7 is a very old standard nowadays. We know that extraordinary items are not allowed to be reported anymore because nothing can be considered extraordinary any longer. Everything that happens to a company is within ordinary conditions of the business. We may have normal and abnormal, but we may not have extraordinary items anymore. Whereas cash flows that relate to taxes, interest, and dividends received and paid, acquisition and disposals of subsidiaries and other business units should be disclosed separately. In addition, components of cash and cash equivalent are required together with a reconciliation of the amounts in the statement of cash flows with the equivalent items reported in statement of financial position. That means that whenever you prepare the cash flow statement, by the end of the statement you should show that actually the sum of the three categories is equal with the difference in the cash account from opening balance to the closing balance. So from one balance sheet day to the other. We will also show this through an illustrated example later. Of course, this is a principle that we already may have thought of. Non-cash transaction should not be represented, should not be included in the statement of cash flows. By the name itself, as the name of the statement implies, this statement includes only cash flows transaction. Non-cash transactions such as depreciation. Depreciation is non-cash, is non-monetary. Another non-cash transaction may be, for example, selling a fixed asset for a profit. Gains from selling fixed assets is non-monetary. It will not be included in the cash flow statement. So everything that happens without cash movement has not to be included, and we are not going to find in the cash flow statement. That means, having said that, means that there are very important transactions for a company that are not being represented in this statement. That is why you should also check other statements. That is why the cash flow statement alone is not enough. That is why we need balance sheet and income statement. Why? Because there are other very important transactions, but because they have not involved cash, they are not going to be included in this cash flow statement. Allow me to mention only one thing. In case you have purchased a big plant, but have not paid in cash for this plant, but you have issued a loan, or debentures, let's say, you have issued bonds, and the proceedings of the bonds have been used to purchase the plant, this is not going to be shown in the cash flow statement at all. But remember, this is very crucial for the activity of the business. Purchasing a new plant is very important to know the profitability for the future, the expected performance for the future. By analyzing the cash flow statement alone, you will not be made aware that this company has purchased new plants because it has not paid in cash, but it has issued bonds to purchase and acquire the new plant. What I'm trying to say is that, again, don't overestimate not only cash flow statement, but none of the financial statements should be overestimated. They are to be analyzed all the four together, because some may have some information missing from the other companies, okay? I guess you got it. We have some test questions, short ones, that we are going to go through them, and after this test question, I'm thinking that for today we will try to show through Excel illustration how to prepare a cash flow statement through indirect method. And we will leave the direct method, which is slightly more complicated, not too much, for tomorrow. So we'll not have too much new knowledge for today. So again, theoretical stuff, what is cash flow statement importance and so on. Indirect method today, and direct method tomorrow, together with tutorials in the afternoon. I think that will be easily absorbable for you. So, I'm waiting for your suggestions. And this will show to me if I've been clear or I have to repeat what I said since the morning. Which of the following will not be included in a cash flow statement? What we do not include? What is non-cash transaction does not have any part with this statement. Remember the name, cash flow statement. Whatever cash flow has happened, whatever money I have received or paid, will be there. Non-cash will not be there. This is easy.
C.
Okay, C. Equipment purchased through issuance of 5 years debentures. Actually, I just said that an example previously, so it was easy. Everything else was involving cash. Inventory purchased in cash, it will be included in the statement. money put into the entity by its owners. Of course, if money is coming in, it will be in the statement. The last transaction, issuance of 5 years debentures. You know what debentures are? Bonds. Bonds and debentures are the same thing, are synonyms. Bonds and debentures are the same thing. Issuance of 5 years debentures in the capital market. If I issue bonds in the capital market, I will collect money. So I receive money, it will be included in the cash flow statement. Good. That's question 2. Which of the following statements is true about the cash flow statement? Okay? Could it be all the statements? Let's take them step one by one. It is prepared on a cash basis principle. Is that true? Yes. We prepared this statement on a cash basis principle. Does it represent the cash flows from all the activities performed by the entity? Yes, again, because it is including the operating, the investing, and financing activities. So that's true again. Does it represent the total change of the cash flows should be equal with the change in cash? Yes, that is also true. So it's all of the above. Remember, the total, the final total in the financial statement, cash flow statement, should be equal with the change in cash from the balance sheet. Otherwise, we have not been quite correct in our calculations. Let's see question 3. The cash flow statement classifies its short-term investments in trading securities as part of operating, cash equivalents, financing, or investing. No financing, of course. No financing. Either cash equivalents or investing activities. If you refer to the one of those small tables that clarify the position, we said that if there are very short-term investments, less than 60 days, that is considered to be part of cash equivalents. So investments in trading securities, in money market, that means investments that I will not hold for long periods. They are going to be considered as cash equivalents. Why not investment activities? Why not investing activities? If you may think of the reason. It's good if you always think why not and challenge. Why not? After all, why not investing activities?
Because they are short term.
They are short term. The primary reason I've purchased this trading security is not to generate revenue from investing. The primary reason is that I have some free money for 1 week, for 1 month, and I want to put them in the market, not just to leave them idle. So the primary reason for investing in trading securities is not to receive interest and dividends, it's just to use the free money that I have. So free money, cash equivalents. The primary reason or the purpose is what makes the distinction. Okay? Another question. The cash flow statement classifies the repayment of a loan received 5 years ago. Okay, the repayment of a loan. You have to classify either operating, investing, financing, but careful, inflow or outflow. Inflow means received, money in, that's obvious, and outflow means payment, money out. Now, this is the repayment of a loan received 5 years ago. When I received the loan before 5 years, I had an inflow. Now that I'm repaying the loan, I have an outflow. So first, it's an outflow. Is it operating, investing, or financing? It's easy, it's financing, cash outflow. Is it easy or not? Okay. The cash flow statement classifies the repayment of a loan, careful, made to other parties. You remember we clearly made the distinction between loans received and loans extended to other party. This is a loan that we have given to the third parties. This is not a loan received. This means that whenever we give a loan to another company, it represents an investment for us. Whenever we give a loan, this means that we have had some money or cash flows free of use, and we decide to use not through investing in stocks or shares, but investing in a loan that we extend to another company. It's an investment for us. Now, when we receive the repayment of this loan, this is an inflow for us and part of, obviously, investing activities. So again, this is part of investing cash inflows. Okay, any questions so far? Good. Which of the following is not usually considered to be part of cash and cash equivalents? Cash in hand, cash in bank, they are usually all part of cash equivalents. Okay, short-term investments in money market, we just explained that they are part of cash equivalents. Usually, if we have some money deposited that are reserved for guarantee or for guaranteeing a debenture repayment, that is not money that we can use easily. Therefore, logically, they are not part of cash equivalents. So, alternative D, the last one. Okay. Restricted cash, we also, I think we have the solution for that. There is the example of entity A, that is a property company. During the year, it has secured 5 million cash units of finance. This is ring-fenced for use only for a specific development. That means that this loan, if not used for this specific project, should be returned back to the entity that was delivering it in the first place. The funds are held in a specific designated bank deposit and can be used only for the purposes that are specified in the loan contract, which is expected to take 3 years to complete. Withdrawals from this account can only be made with the approval of the lender when specified milestones are met. This is very similar to the construction contracts where we receive, for example, money from the government to build, let's say, a school or a bridge or a road, and we cannot use this money for other purposes. And we need the permission from the lender, in this case the government, each time we make some withdrawals to use for the specific project, not for other uses or needs that we may have. Okay. At the year end, we have still 1 million cash units, we have still 4 million cash units in the bank account, and we have consumed or used only 1 million cash units. How will we consider that for the purposes of cash flow statement? This is a question. The money has been obtained in order to support long-term cash needs, which is the completion of the development over the 3-year period. So this is a very specific purpose project, and we can use the money only for this purpose that we are mentioning. Although this account may not have a specified term, that is not 3-year terms or any other reason, the withdrawals can only... Do you have this solution in your slides? No? Okay. Thank you for the answer in chat. I will provide them for you. I saw a couple of you taking pictures, and this is when I understood. I will send this slide over to you, not need to take pictures, and I apologize for maybe omitting that by mistake. The basic thing that we are saying that is that this cash account of 4 million that we still have in hand at the end year is not part of cash equivalents, because we cannot readily and easily use this part of cash for our needs. It does not fulfill the criteria that usually should be met, should be fulfilled by cash and bank accounts. This is a very designated, purpose-specific cash account, okay? I will send the slide over to you in case it is needed. Okay. I think this was the last. Oh, we have still some more. Okay, let's go through that again. I think you have this. Classify, identify the followings either as cash flow from operations, cash flow from investing and cash flow from financing. From this time, we will use very often these acronyms, CFO, CFI, and CFF, so get used with that. So property purchase is cash flow from investing. Treasury shares repurchase. That means when we are withdrawing some of the shares that we have previously issued in the market. Usually this is part of the cash flow from financing because each time you withdraw shares from the market, you diminish the amount of shares outstanding, but also this will have an impact in the financing section, equity section of the balance sheet. So again, treasury shares, anyone knows what they are? Because I'm just continuing. What are treasury shares? Don't confuse them with treasury bonds. It's not the same. Treasury bonds are issued by governments usually. We are not talking about public finances here, no governments included. We are focusing companies. What are treasury shares? You seem to know the answer. What is your name, sorry?
Viola.
Good. It's good to start to know each other. Yes, Viola, please.
They have a really low interest rate, so
You mean the treasury bonds of the government?
yes.
Okay, we are not talking about that. What about the treasury shares of a company? What are treasury shares? Anyone? Ever heard about that? Any volunteer? I would appreciate that. Don't be discouraged. You may know the answer. Treasury shares are withdrawals of common shares of the company from the market.
And then we report it from the
Yes. Your name, please?
Tan.
Mm-hmm.
So it's we report the shares we issued.
Where should we do that? Facebook has issued shares in the market. Okay, these shares have been purchased by different shareholders. After 2 years, Facebook goes in the market and repurchases its own shares. This is treasury shares. Why does the company do that?
They want to increase the price of the share.
Every time, you know the rule of economics, when you increase the demand, the price will increase. So Facebook or another company may think that in a moment the price share is undervalued and they will intervene in the stock market, repurchasing the shares, thus increasing the demand, increasing the price. This is the primary reason. Now, each time that I repurchase my shares, that means that this will change the structure of the equity in the balance sheet, and therefore it is part of cash flow from financing activity. Once again, why? It changes the structure of financing of the company. More to say about treasury shares later at the next lecture of earning per share. Non-current loan decrease. It is a non-current, but still it's a loan. Decrease, that means that usually it's a payment, part of cash flow from financing. Again, the loans are part of the financial structure of the company and will be included in the financing activity. Selling inventory for cash. Now this is the common business that most companies does, so it's cash flow from operating. Okay, treasury shares reissue. Remember Facebook? They went in the market, they repurchased their shares. A couple of months later, they see that the share price is very high. They want to lower it a bit because now it's overvalued. And they go back in the market and they reissue their treasury shares. Simple. Which category does this belong?
Finance.
When I repurchase them, it impacted the financial structure. The same thing, it will happen when I reissue them in the market. So part again of financial activity. Again, why? Every time I repurchase, repurchase and reissue again, that will change the financial structure of the company. Current loans increase. Part of financing activity again. Loans, debts, debentures, always financing. Okay, we have others, common stock issue. Whenever we issue shares or stock, either it be common or preferred, that is part of financing activity. Land purchase, investing, good. Purchase of common stock of another entity. I'm not issuing stock, I'm not repurchasing my own stock. I'm purchasing stock for another company, but that is an investment for me. So it is cash flow from investing. Cash dividend paid. Remember what we said about dividend paid, either operating or financing. I chose here to put financing. You could have written cash flow from operations and you would have been correct as well. Cash dividend received?
Same.
Investing.
No, not the same. It is received, either investing or operating. I put investing here. Remember, operating is always. You could be, whenever you hear interest, dividend, paid or received, you can put operating and you are right. Okay? Remember this? Write it down. So whenever you hear dividend, interest, received or paid, you can include in operating and you are correct. These are special cases. That's why I put it there so you can learn better. Okay, interest paid, you could have said operating and you are correct. Another option, another alternative allowed by IS 7, other than operating for interest paid is financing. So operating or financing. Okay, I think, oh no, we have another thing. We'll see this later. First, I think that we deserve a short break, 5 minutes, not more. I will prepare the Excel spreadsheet for the last hour. The remaining of the slides we will cover tomorrow. So enough theory for today. I think that you got enough concepts for the first day. We will go through the indirect method and then tomorrow we'll continue that. You are free for the break.
想到了白写，特别是一些小说的。
Usually, we have a lot of information that we need to understand and read very carefully before we start. I may understand that for many of you, this kind of information is quite new. For example, combining together the full data and information from an income statement and from profit and loss account and other comprehensive account, and then from the balance sheet, it's too much. So we are going to take them slowly and understand why it is provided in the first place and how we can use this information in order to prepare the cash flow statement, okay? So what you will usually find is an Excel spreadsheet with 4 different sheets. In the first one, you will find one of the statements, in this case the income statement or profit and loss, it's the same thing. Then in the next sheet we have the statement of financial position or the balance sheet as we know that. Then I will use the next sheet to prepare the cash flow statement with the indirect method. Our objective for today, if we are lucky enough to finish on time, if not, we'll continue tomorrow. And then we will try to build the same statement under the direct method. The two methods have many similarities, so in case we learn how to prepare the statement under the indirect method, we've made like 2/3 of all the work, so the majority is done today. But still, let's understand what we have as information for this company. The statement of income, or the statement of profit and loss and other comprehensive income, for the 30th of September for 2 consecutive years. In this case, let's say 2022, and 2023, but it doesn't matter. That's why you usually find this X number in the dates or the years over here. So you can assume which one you want, 2022 or 2012. It doesn't matter so much. So you see the profit and loss statement has these items over here that we usually find in a statement as such. Revenue. What is the revenue? Revenue from sales or revenue from rendering services. It doesn't matter at this point, this is just revenue for the companies. You can see that the amount of the revenue is given for the 2 years, and after that we have the cost of sales. We also knew this cost of sales amount, with other words, as cost of goods sold. If you remember well, we use this acronym, this abbreviation over here. Cost of sales and cost of goods sold is the same thing. Also, please allow me to be very, very slow in explaining simple things, but maybe they are not for the bad. We say that revenue less cost of sales equals the gross profit. So what we have done here is that from 44,900, we have subtracted 33,300 to calculate the gross profit 13,600. Something else that you may notice, maybe it's too simple to pinpoint and to bring to your attention, but I'm doing nevertheless. You see that what is an expenditure is with a minus there. What is an income or a revenue is a plus. Whatever you have as an expenditure is with a minus, or otherwise in Excel it will show in brackets, as you see. Okay? So this is our convention in this chapter. In the cash flow statement, whenever we have a negative amount, we will show that in brackets or with a minus. Whenever we have a positive amount, it will be a positive sign without brackets. This is important because the majority of mistakes in preparing the cash flow statement is just a sign. You will find that you are completely correct, you have done nothing wrong, you just missed a small minus somewhere, and that causes all the trouble. So in order to avoid the problems arising from the mistakes in signs, we'll do this agreement together. We'll use this convention. We'll put positive signs for revenues, income, and cash inflows, and negative signs for expenses and cash outflows, okay? So having made this agreement together, it's easier to continue. Now we have distribution costs, and we subtract this distribution cost and administrative expenditure from the gross profit. We also have, and you can see that these are with minus over here, that means that they are expenses. Now, something about investment properties, a clarification is needed at this point. The investment properties are properties, maybe buildings or machineries, that the company purchases not to use in the ordinary course of business, but to have them as investments. That means that, let me give you an explanation. A manufacturing company may have buildings that it uses for plants, as factories, as plants, but also it may have some buildings that it gives or rents to other parties. Those parts of the building that are not used for manufacturing purposes or for common operation purposes, but are used to give for rent to other parties, are known as investment properties. Again, investment properties are properties, but are not used for manufacturing or operating reasons. They are used for investments, as investments. That is a very common case in many companies when they have free infrastructure resources. They rent them, buildings or plants or machinery or auto vehicles, they rent to other parties in order to generate some extra income or extra revenue, okay? Now, what you see here from investment properties are two different results, and let me explain each of them. The first one is rental received. That means that we have rented this property to another company and we are receiving some rent income. Because it is rent income or rent received, it is with a plus. Remember what we agreed before? Something that is coming in, something that is a cash inflow, something that is income will be shown with a plus. Again, investment properties are properties that we rent to the third parties. When we rent to the third parties, we receive some rent income. And the rent income related to the investment property, In this case, it's 350. Remember, the amounts are in thousands, okay? But I'm just avoiding the thousands. I'm just mentioning the number 350. Now, you maybe have to see the other transaction that needs some explanations as well. The investment properties, we are told that are being valued according to the fair value method. You remember for many times I think, we mentioned that usually the companies may choose to account for assets in two different methods, amortized cost or fair value. Now this company has chosen to account for investment properties using the fair value. What does that mean? At each ending of period, at each 31st of December, the company has a look at the fair value of each of the property it has invested in and reflects the changes in fair value to include them in the result of the period, okay? Now that means that if we have an increase in the fair value, that will show as an income. If we have a decrease in the fair value, that will show as an expenditure. Probably you have already covered this in the first part of the course. Again, when we have increase in fair value, that is income. I'm not mentioning if it is other comprehensive income or period income yet, I will mention that later. But anyway, every time you have an increase in the fair value, that is an income. Every time you have a decrease in the fair value, that is an expenditure, okay? Now, who can tell me, we have here a minus transaction, that means that is an expense. What has happened with the fair value of the investment properties in 2023? It has been an increase or a decrease? It is minus 700.
Decrease.
It is a decrease, good. What about previous year, 2022? This would be plus.
Increase.
1 year ago, we had an increase in the fair value. After 1 year, we have a decrease in the fair value. That's pretty common. When we use this model of accounting for assets, we will monitor the valuation and fluctuation in the fair values, and we'll show them in the income statement. Now remember, usually the fluctuations in the fair value are part of other comprehensive income over here. I'm putting that in red, okay? So this is what you learned, that usually the variations in the fair value will be included in the revaluation reserve in the balance sheet and other comprehensive income in the profit and loss statement. And that is correct, but that is true for those fixed assets that are the source of the primary business activity, and investment properties are not. They are not the primary source of generating revenue. They are just random buildings that we are not using for some years, and we are just renting to third parties. So that is like a side business, a second-hand business for us. And being a side business, I'm not interested to include the fluctuations in the fair value in other comprehensive income. I'm just recording them in the results of the period. So again, usually the variations in the fair value will be part of other comprehensive income, and the fluctuations in fair value of other fixed assets for this company are part of other comprehensive income. The only exception is investment properties. They are like a side business. I'm not interested to keep track of surpluses, declines, and all the procedures that are really complicated with fair value thing. So I'm just including them in the result for the period. Whenever I have an increase in the fair value, it will show like an income, year 2022. When I have a decrease in the fair value, it will be an expense, 2023, okay? So this was a necessary explanation to understand what comes later. Then we have finance costs. That is another name to say interest expenses. Okay? So whenever you hear finance costs, you may very well write there interest expenses. That is like a more common term. Profit before taxes, of course we say less every time there is an expense, and we say add or plus every time we have an income. Then we have the profit before taxes, that is the taxable profit. We usually calculate the amount of taxes to be paid, income taxes, on the amount of profit before taxes. Now, the income tax expense, usually this abbreviation over here, ITE, but income tax expense, you may call it like that, is calculated as an expenditure on the taxable income. And what we do is that we deduct the income tax expense to calculate the profit for the year. Now, the profit for the year, 1,800 cash units in thousands in this case, is the profit or the realized profit that the company has generated. But be careful, according to the financial reporting standards, we have to add to this amount of the profit some other comprehensive income. What are other comprehensive income? I bet that you have discussed in the first part of the course. What are other comprehensive income? And it may be other comprehensive expenses. The sum between profit for the year and other comprehensive income will give total comprehensive income. And then that is why the name of this statement is income statement and statement of other comprehensive income. What are these with such a long name? What do they include? Any idea, even if it is wrong, we may discuss. What is other comprehensive income? Have you discussed the revaluation model for assets? In the previous part of the model, did you discuss about the revaluation model? Fair values? Okay. If you have surpluses in the fair value, how do you account for them? Where do you include these fair values, surpluses? I think I left 2 homeworks yesterday for you, right? Did you do the homeworks to read about provisions? It was one, and because I'm thinking to give another homework for today, I don't know how effective that is. If you haven't done the homework for yesterday, maybe today is the same, but any idea what other comprehensive income is?
Our income and expenses that get realized.
Okay, that's a good explanation that I like. These are expenses and income that have not been realized. Okay, you can write it down. What does it mean that they have not been realized? Not being realized means that they are based in market perceptions that may be very well reversed in the future. Okay? And as they may be reversed in the future, we should not be taxed and pay taxes on this income. So again, other comprehensive income are income or expenses that have not been yet realized. They are derived from the perception in the market, from observation in the market, and very well the market may change very soon in the future. And this income may never be realized. As they may never be realized, I should not pay taxes on this income. This is why other comprehensive income is after taxes, as you can see. So you will be taxed for realized income. What are the realized income? Revenue from sales, you have received them. Or rent received, you will receive or have received them already. They are realized income. They are connected with your realized transactions, with an invoice that you have or inventory that you have sold, with rents that you have offered. They are realized transactions. They really have happened, okay? Whereas other comprehensive income, just think for a moment, they have been generated from an increase in the market value of this building. Let's assume University of Turin has this building it has a fair value of a certain amount, and the fair value is increased comparing to the other year, to the previous year. This does not mean that University of Turin is receiving any money because the value of the building is increased, right? The value of the building is increased, but I'm not selling it to realize any income. As I'm not realizing any income, I should not pay any taxes. These are other comprehensive income. They are income that are not realized, and maybe they will never be realized in the future. The increase in the value of this building is something real, but is not bringing real income for the company. Why? Because the company, University of Turin, is not selling this building to cash in the increase in the income. Is that clear for everybody? So any item that you will find in other comprehensive income is related to market values, but you do not have any realized profit because of that. And maybe you will never have, because maybe you will never sell this building. You have to account for the increases and decreases in the fair value in the market because the financial reporting standard requires that. But actually you are not realizing any of this, and you should not pay taxes on this, okay? So again, comprehensive income are income or expenditure that relate to the variations in the market prices. Usually they relate to fair value concepts or conversion rates usually, but many times they are not really realized, and therefore they are kept separately in a separate section known as other comprehensive income. Okay, I hope that is a little bit more clear because it helps to continue what we are starting. Some other information that is always needed to know what is going on. Now, the company acquired a new investment property. Remember, the investment property were properties that we are keeping to rent to other parties. They acquired new investment property with 1.4 million. On this date, it also transferred one of its investment properties to property, plant and equipment at its fair value 1.6 million. That is, I have several buildings. At one point, I'm buying new buildings to rent out, and part of the buildings that I'm renting, I'm transferring to the building that I use for my primary purposes. That is the meaning of these movements. That is something that happens really very usually, and it's a common transaction in companies that have both of business activities. So again, what is happening is that I account for business investment property, I account with fair value method. And this year that we are explaining and talking about, we are purchasing new investment properties and we are paying $1.4 million for that. And in the same period, I'm reclassifying some of the buildings from investment properties to PPE, property, plant and equipment. My main fixed asset that I use in my operating activities, either to plant or to merchandise or to manufacture something. It doesn't matter, okay? Now, here is the keyword. Kingdom adopts the fair value model for its investment properties. And this is why I spend so much time to explain the fair value model, because this is the model used by this company. Another clarification. Company has a policy of revaluing its other properties. The other properties are property, plant and equipment, PPE, regular machineries and buildings that we use in our common, ordinary business. We have the policy to revalue to market value at end of each year. That means we also use the fair value method for the other properties that we have. And the key phrase here is this. The other comprehensive income, remember the red colored item over here? This other comprehensive income and the revaluation reserve that is part of the statement of financial position that we explain later, they both relate to the properties, not investment properties, but to the property, plant and equipment. Okay? So once again, I'm repeating what I said previously. This company has two separate classes of property. Investment property that it rents out to third parties, and property, plant, and equipment that it uses for its own purposes, producing, manufacturing, and so on, whatever. This company uses fair value for both classes, but it shows the fair value results into two different places in the income statement. The fair value changes for investment properties that are like a side business, a second-hand business. It includes in the taxable results. So they are before the taxes over here. Why? Because the company is not interested to give very detailed and complicated result for something that it is of a secondary intention for her. Whereas what is the change in fair value from the primary buildings and from the primary property, plant, and equipment, it is included in other comprehensive income over here, okay? Is that more clear? Does it make sense? Or is it too much to process for today? Okay, take as much as you can for today. Think about it and sit on that for tonight, and tomorrow we'll go over the same things again. I know that cash flow statement again is not easy. To prepare the cash flow statement, you have to combine the information from all the other statements, and moreover to convert all the transactions that you are accustomed to think of on an accrual accounting basis, to convert them in a cash accounting basis. That is not easy, not only for you students, but if you go out and ask some accountants or auditors, they will say, no, cash flow statement is not for me. I don't want to deal with that. And that's okay. It's not something easy, but it's part of our curriculum, and we have to learn about that. So it's a part of financial information that you should not miss. And we have to try to do our best to understand as more as we can. Okay, another piece of information. Regarding the property, plant, and equipment, so the regular fixed assets that we use in our primary business, the depreciation of this item during the year was $1.5 million. The depreciation expenditure, I hope that is familiar for you, so I'm not stopping to explain that further. Also, we have another information, an item of a plant with a carrying amount of 2.3 million was sold for 1.8 million, generating a loss on sale of 500,000. Now, you have probably covered the sale of fixed assets in the first part of the course. When you sell fixed assets with loss or gain, you have covered in the first part, and probably you have mentioned that whenever I'm writing over here, these are rules that you know, but just to remind ourselves about that. When you sell at market value higher than carrying value is the net book value that is in the financial statements, then you have gain on sale of fixed assets. So once again, when you have a market value higher than the carrying value, you are selling at a gain. This is a gain from selling fixed assets. Why I am writing that? The gain on sale of fixed assets is not a monetary transaction. Gain on sale of fixed asset is not a monetary transaction. Remember that. What is monetary, what does involve cash is how much cash you have received. Being that a loss or a gain, that is not monetary, okay? So maybe this will come even clearer at the second thing. Now, when you sell on the other side, at market value, which is lower than carrying value, you have a loss on sale of fixed assets, okay? Again, this is a rule that you already know. Why I am mentioning here is that, again, the loss on sale of fixed asset is non-monetary. This is the example that we are having here. Loss is non-monetary expense. It does not involve cash. Actually, you can easily understand, I'm selling at a loss over here. Loss is 500,000, and yet I am receiving $1.8 million. Okay, that is very obvious that cash is involved in there. I am receiving 1.8 million. This is the effect in the cash flow statement. In the cash flow statement, I should include a cash inflow from selling or disposal of fixed asset 1.8 million, whereas this loss of 500,000, this is not monetary. That is just to represent that you are receiving less than this asset is worth to you. This asset is worth 2.3 million, but you are not able to sell it for this amount of money. You sell it for less. And then the difference between 2.3 less 1.8, 500,000, this is your loss. But this is a loss not in the monetary concept of the expenditure or cash outflows, okay? So please remember this. Either being gains or losses on sale of fixed assets, they are non-monetary transactions. They will be used to adjust the financial statement, but they do not represent cash inflows or cash outflows. In our example, we have 500,000 loss. That does not mean that I'm paying 5,000. No, instead I'm receiving 1.8 million, but I'm not receiving the same amount that this property is worth to me. It is worth 2.3 million. As I'm receiving less than that, this means that I have a loss. But the monetary effect, it is 1.8 million. Okay, try to process that and understand that. And something just to close this discussion. This 2.3 million carrying value relates to the value of this property probably from 10 years ago. I purchased this property 10 years ago and I paid this 2.3 million 10 years ago. Whereas I'm receiving 1.8 million now 10 years after. And that's perfectly okay. This is how business works, okay? And I have to show the receipts or payments in cash in the periods when they happen. When I first purchased this machinery, 2.3 million, 10 years ago, I showed the cash outflow there in the cash flow statement of that year. Now that I'm selling it, I have to show the cash inflow of 1.8 million. The loss or gain, that depends on the market prices. And that is just an accounting adjustment that I need to do, okay? I hope that is more clear. Except for it took us a lot of time to explain the situation, but it's good to know what's going on. As I said, if we don't finish today, we have the whole day tomorrow to cover the financial cash flow statement again. So let's try to understand. Now, this is the statement of financial position on the balance sheet. Usually there are the same items over and over again. From one company to the other, we have the same items. PPE, property, plant and equipment. You see that there is an increase in value from one year to the other. And then we have the investment properties over here. You can see that the company really has two classes of properties. One that it uses for its primary business, and one that it uses for as an investment property. Then part of current assets, we have inventory, trade receivables, and bank account. Now, just try to understand for yourself if you are familiar with every item of these financial statements. So inventory represents inventory at hand. Trade receivables represent the invoices that we have not yet received from our customers. So these are some rights to receive payments from customers in the near future. Okay, this is trade receivables. Now have a look at the bank account. Remember that the bank account can go with a minus, and that was overdraft, if you remember. This is the case, this is the example here. At 2022, the bank account has a value of 300,000. Again, the values are in thousands here. Whereas in 2023, you find nothing there. Okay? If you carefully check 2023, I'm just going down, you find under under current liabilities, you find the bank account. You see, the bank account here, part of current liabilities is 200. That means that we have an overdraft in the bank account for $200,000. I mentioned during the explanation of today's lecture, when you go with a minus in the bank account, that is an overdraft, and you will find it under the current liabilities. You will not find it under bank with minus, okay? So once again, what is overdraft? Every time when you have less funds in your current account. And in these cases, it is included as part of the current liabilities. You should be doubting when you saw this empty cell in Excel here and thought, what about the bank account? Is it zero in 2023? Go down, check the current liabilities, and then you find it. You have a liability. That means you have taken an overdraft of 200,000. Okay. Next, the equity liabilities. We have equity shares. You see that we have an increase in equity shares. That means that probably during this time we have issued new shares from 15,000 to 17,200. We have the revaluation reserve. Remember, this revaluation reserve is related to the fair value application for the property, plant, and equipment. Okay? That means that if you have a decrease in the revaluation reserve, and actually we have a decrease from 2,500 to 1,200, what is that related with? This decrease in the fair value. That is related, remember the explanation, that is related with the other comprehensive income. You see this minus 1,300 over here? You should check if it is the same. So the decrease in the revaluation reserve is really 1,300. It's not your job to check, okay? But as we are told that other comprehensive income and the revaluation reserve both relate to property, plant, and equipment, you can have a check for yourself. This is a wise thing to do. When you deal with financial statement and you know that the items are interrelated from one statement to the other, have a look and check if the items correspond to each other. That's a wise thing to do, okay? Before you start analyzing and interpreting the company's liquidity and so on, try to check the balances between figures. This is something very simple to do, but again, it gives you confidence in the credibility of the amounts that the company has reported. Okay, so we may continue here. We have also retained earnings. We have decreased the retained earnings over here, you see? Now the retained earnings difference, let me show, from the beginning to the end of the year, it is a decrease by 1,000. Who can tell me why we have decreased the retained earnings? Is there a reason? Why should we decrease the retained earnings? And let me add another explanation. Do you see the profit and loss account here, the income statement? I have a profit for this year. As I have a profit for this year, I would at least expect the financial position statement, I would expect an increase in the retained profit, not a decrease. Okay? Don't write anything, but just let me remind you of the equation of the retained earnings statement. Opening balance of retained earnings plus net income or of the year less dividends is equal to closing balance of retained earnings. Now, I think this is a very simple equation, equals, but it helps us to understand what's going on here. That means that usually what I find in the beginning or the opening balance of retained earnings, I should add net income, then I should subtract the dividends, and then I'm left with the closing balance of the retained earnings. Can we make all the calculations here? Remember, the dividends, I will need that amount when I prepare the financing activities of cash flow statement, because I need to account for the dividends paid. So let's account for that right now. How much dividend we paid? The opening balance of retained earnings was 8,700, right? Over here. You will always find the earliest year as the farthest column in the financial statements. So the opening balance is 8,700. What was the net income? It was 1,000 and
800.
Okay.
Yes.
Thank you. 1,800 less dividends. Well, an X, I don't know that, how much the dividends are, but I can calculate. The closing balance is 7,700. How much dividend I paid? Okay. I think it is 2,800. So if we make the calculations, the dividends that we have paid during the year, it is 2,800. Okay? Is that clear to at least most of you? Again, this is something that we need to do every time. Okay, sometimes the questions are easy. The exercises will directly tell you, company paid this much in dividends. And that is pretty easy. But some other times, the exercise will not tell you the amount of dividends. It will not be disclosed. And you have to calculate by combining this amount. Opening and closing balances of the retained earnings, the net profit for the year, and if you combine them together, you can calculate the dividend, how much dividend you paid. You have obviously paid 2,800 in dividends because you have a decrease by 1,000 in retained earnings. That means you have paid all the amount of profit for the year plus 1,000 from the reserves of retained earnings over the years. So 1,800 result of the year plus 1,000 decrease in retained earnings. 2,800 is the total dividends you have paid to your shareholders. Okay? Shall we continue? Obviously, we cannot finish in time, but at least we can use some more minutes to explain the other items in financial statements. Or you are too tired for today? The second option? I wanted to, okay, I'm not starting the cash flow statement. I'm just trying to, as we started to explain the investment properties, I'm trying to gather information together about that. Can we get that now? If it becomes too difficult, tell me, stop for today and we continue tomorrow, okay? Now, what we have shown here for the equity shares, I'm just putting that a little down over here because I need the space. Let's see what has happened in the property, plant and equipment, okay? A lot of things may happen with this account during the year. Remember this, property, plant and equipment are depreciated, are revalued in the fair value model. Remember that I also had some reclassifications. Remember that we took some 1.6 million over here From investment property, we re-included them in the property, plant and equipment account. So many things are happening in there. How will we account for that and how to understand? And beyond that, another thing to add to the complexity, that's why I said that if it becomes too much for you, say me to stop. Something else is that we have sold a piece of property with a loss. So we have to include everything together. Now, something that is logical to say, like an equation, it is that opening balance of property, plant and equipment plus increases less decreases, where decreases in PPE are always, they relate to the property, plant and equipment always, equals closing balance of property, plant and equipment. Do you agree with what I wrote there? It's pretty logical. I'm trying to put or to represent things very simply to you. Property, plant and equipment, or investments that you have, the opening balance, if you add the increases and you subtract the decreases, it will be equal with the closing balance. Is that okay for everybody? Does that account logically? And okay. Now, the problem is, what are the increases? Can you mention any increase in the value? Can we mention any increase in the property, plant and equipment? How do I increase my properties, by the way?
We purchased the
How
new,
can we become richer?
we purchased new things
Mm-hmm.
and they increased the rent.
Good. Purchases. We may have purchased new property, plant and equipment. This is a way to increase them. Okay? Mention something else. Purchases is one. Another thing.
Increasing fair value.
Reversal or
Increasing fair value.
good. Something that we are expecting with the model that we use. Increase in fair value. If I write fair value
FAV.
V, it's okay. Increase in fair value will also increase the value of the properties that I currently have. Not only through purchasing new equipment, but also increases in fair value. Remember something specific for this company. Do you remember that we had a reclassification? So we took some property from investment properties and we reclassified them under the property, plant and equipment. So reclassifications. Okay? So these are all examples of increases in the property, plant and equipment. Okay. This keyboard. Okay, so increases are purchases, increases in fair value, reclassifications, and so on. Can we think of anything that will cause decreases in the value of property, plant, and equipment? Something very common always with the PPE is good. Bravo. This is what I was looking for. Depreciation is the first one. We depreciate them, and that reduces their value. Something else. Decreases in fair value. And actually this was the case in our company. Usually, as we said, as we saw here, the other comprehensive income were with a minus, and that means that we do not have an increase in the fair value. We have a decrease in the fair value. And we also combine that with the information, as we said, in the valuation reserve. It really decreased, so we said that it is confirmed. So something else that causes decreases in property, plant and equipment is decreases in fair value. Something that I'm not writing there, but that may happen, is reclassifications from PPE to another category. But I'm not writing there because it is very specific. Something that we need to add though, and that usually happens in property, plant and equipment, we purchase, but we also sell existing property. Selling existing property, plant, and equipment. And actually, this happens not only to our company, but usually many businesses every year would sell existing machinery to replace them with newer technology. So we expect to have a lot of movement in purchasing and selling existing machineries. When they use the fair value, expect to have the changes in increases and decreases in fair value, and always expect to have depreciation. That is always true for every company for every year. This reclassification is specific only for our example. Now, we know all these changes have happened. What I want you to do as a homework tonight, today, this afternoon, because we cannot continue anymore, I guess. Write which is the open balance. It's quite easy. It's not a difficult exercise, but it will be fun maybe for you. Let's see. The opening balance of the PPE is 25,200. You see here? Okay. The closing balance of the PPE is 26,700. You know how much depreciation is. How we know that? Here. We have the depreciation of property, plant, and equipment, 1.5 million. Okay? So you know the depreciation, you know the decrease in fair value, you know the value of selling existing PPE, you know the reclassification. What you have to calculate here, it is the purchases of PPE. If you calculate the purchases of PPE, this is a very important item for the cash flow statement. Remember that for the investing activities, I have to say, how much did I pay for purchasing new equipment? And this piece of information is missing here, is not provided for me. I should calculate, combining all the information, and that's why I wrote all of that. I have everything except for the purchases. So one thing that you should do is to calculate the purchases of the property, plant, and equipment. Okay? Consider that as a simple homework. It's only one tiny step in the whole process of preparing a cash flow statement. I promise. The preparation of cash flow statement involves many steps. Some of them even bigger than this, but consider that a tiny step. We did some pre-calculations together. For example, we calculated the dividends. That's good. Now we calculate the purchases of PPE, and these are all figures and amounts that I need to insert in the cash flow statement when I prepare that, okay? Any questions so far? Good. We have 2 hours of break. You can go out and come again. I think it is allowed to go out and come again, right? Under COVID restrictions, you can go out of the building.
Yes. Yeah.
Because last year you couldn't go out during the break. So after 2 hours we meet for the tutorial involving inventories. I think that you will appreciate inventories now that you were introduced to the cash flow statement. I think that you will find inventories easy, and we will have some exercises to solve.
Prima mangiare.
Buon appetito. Allora ci vediamo online. Ma sai che? Guarda, prima ho fatto così. Sento che. No, da qua. Questo di oggi sì. Mentre che lei spiega lì, ho fatto una foto e poi ho fatto un screenshot così copia quello qua. No. Prima volevo scrivere tutto ma ci vuole. E poi.
Ho fatto la manuenza.
Brava.